super excited to be here today. We have Mike Lorino. He is the CEO of AssumeList. I'm going to tell you what that is in a second. I also have Nora here, Nora Simpson. She's head of education. So you're going to love Nora. And they're going to talk to you today about what AssumeList is. I'm just going to break it down and give it to you this simple. When I joined real estate 30 years ago, there were HUD homes, and you could buy a home, $500 you're in. I'd have one in Folsom, three in Elk Grove. Now in the MLS there are 300. In Folsom there were 100, but there was one HUD home in Folsom. There were none in Roseville, three in Rockland, and people would literally shop from that list because I got a job and I got $500. AssumeList is the same way. They're going to have properties that are available to you a lot more than what I had at HUD. The difference is you get to assume the interest rate of the seller that's in the property. And what it does, for example, a $500,000 loan through working with AssumeList with 10% down, the payment is on a normal payment of 6.5% interest rate is $3,400. But a lot of people have interest rates 1.9, 2.5, 2.9. I chose 3.2%. At 3.2%, instead of roughly $3,400, it's $2,600. That's $800 a month less payment. So you take people like, I'm too nervous to buy. I'm too nervous to buy. The payments, $3,400 a month. And you go, no, it's actually $2,600 a month. And by the way, the tax benefits will probably be about $650 a month. So the payment literally is going to be like $1,950 a month. And they go, oh, if you're not using the tax benefits of homeowners, the number one thing you can do for your taxes is buy a home. The government wants you to buy a home. So your gross pay and your net pay, your net pay, the difference between net and gross, probably in a home if you're in that category to buy a home like that, easily $650 a month tax savings. Go talk to a tax professional. But so really your $2,600 payment, when you rent for 26, it's 26. But when your mortgage is 26, the actual cost to you is about $1,950. Talk to a tax professional. So you could pay $3,400 a month or $1,950 through AssumeList. Again, if you understand, that's the difference between having a 6.5 interest rate and doing one at 3.2. Now, if you end up getting one at 1.9 or 2.5, it's even lower. It can take that payment down to $1,700 a month. So this is an incredible opportunity for you to be creative and scrappy and and trust me, oh, they won't do that. They did it. I'd have two homes in Natomas. There were 200. They'd pick one of the two homes and buy it. And I got paid like I sold so many HUD homes. It was insane. I didn't have to show 30 homes. I showed one. You get your choice. Here's two in Fair Oaks. Which one do you like? I like that one. They would do it. So I'm super pumped about what you created here, Mike and Nora. You guys take it away. And I hope you pay close attention. This is a tremendous opportunity.
Thank you so much, Brent. Really appreciate you taking time out of your day to introduce us and to co-host this with us. So for the benefit of the audience here, I met Brent, I guess first time I met you would have been at EXPCon last year. And Brent was kind enough to meet with me and some, a small group, like a little one-on-one session. I said, Brent, I got something for you. I think you're going to be excited about this. And most of his team, his staff is like, yeah. What are you doing here? Who are you? And why are you trying to get in front of Brent? And it took Gary Meek to say, no, Brent, Jennifer, you really want to hear what they have to say. And I met with Brent, and his eyes lit up, and I was excited that he was excited. He says, my 30 years of real estate, this is the most exciting thing that I've seen in a long time. That not only are buyers and sellers interested, but the agents should be all over this, and the agents are excited. And I'll never forget the story you shared with me, Brent. You said that that night, you met with your kind of executive leadership team, your little circle, little huddle, and you leaned in. You said, I may have access to a tool that's going to give you access to every single home on the market with a 2.5, 3% interest rate. It's not cheap, it's expensive, but it's game changing. And you said they were salivating at the mouth. They really wanted to hear more about it. And you said, how much does it cost? Or they said, how much does it cost? And you said, it's free. And everybody started laughing. And so we've come full circle. And this is truly a free tool provided to you with help from Brent, but provided to you free of charge through eXp Corporate. Because this truly is one of the most exciting and greatest opportunities as a real estate agent, I think, today available to you bar none, the one skill that you should learn in 2026 is learn about assumable mortgages. It's good for buyers, it's good for sellers, it's good for recruiting. Regardless of where you want to take your business, this is something that you will want in your kit bag. I'm going to introduce Nora Simpson and we'll kick things off. Nora is my head of training. I'm very lucky to have her on the team. She has an immense background of she's written multiple books in the neuroscience of sales. She's built out all of our training materials. She hosts all of our daily training that we do for our agents every day, Monday through Friday. So Nora is going to open things up, and then we're going to kick right into the material that we have for today. Forum for today. So how this is going to unfold, we've got the chat rolling. Nora and I will kind of routinely go in and start answering questions. Feel free to ask questions in the chat. There may be some opportunities, depending on how unwieldy you want this to go, for folks to chime in and ask questions in real time. We want to just make sure we cover all of our material. At the end of this session, close to that 1 hour mark, we're going to post the registration code in the chat, which you'll use to register to get your free account on AssumeList. So this is no cost to you, provided completely free of charge, thanks to our partnership with eXp and all the support that Brent has enabled this to happen. So we'll kick things off. Over to you, Nora. And
Mike, can I just say one thing?
Yes.
I always knew it was great to get your client to assume the mortgage rate of someone that's like 3-4 points less than thinking of them, and it just makes sense. I'm like, but how do you find them? That was the thing. How do you find them? You had to really like sift for gold and do that in the streams to find those. Now, push button, here's the list, shop away.
We're going to cover all of that. How do you find them? What do you do once you find them? Cash gap financing. What are the hurdles? How do you get the servicer to approve them? I'll just say right at the bat, I got 3 new buyers under contract in the last 3 days. All assumptions. Everyone is either a 2.25, 2.5, or 2.75% interest rate. They are each saving anywhere between about $800 a month or to $1,200 per month every month.
And when you're talking to people at open houses or following up and go, I just sold a home for 500 or a million or whatever it is, 750, and I got them a 2.5% interest rate fixed. And the payment, instead of being this, was this. And this is what I do. Nobody else does this. I do this. This is why you want to work with me and tell stories. Stories tell, facts tell, stories sell. Tell the stories. You'll get a momentum and it's game over. Go ahead, Nora.
Awesome. Thank you, Brent. Nora, over to you.
Over to me. Well, hi, everybody. I'm so excited to be here. And with the amazing revelatory Mr. Brent Gove, it is such a pleasure to be here with you again, sir. I was at that meeting at eXpCon, and we had such a good time together. So I love numbers. So let's talk some numbers. 70% of homeowners in the US have an interest rate below 5%. You might want to write that down. It's more important for your recruiting efforts, right, than your buyer or seller discussions. But all of you are building out your teams, right? Because there's an unlimited opportunity with eXp. Hello, right? 70%. Thank you, Crystal. Thank you for that nod. 70%. Okay, write that down. Now, in a survey by the Associated Press, 80% of homeowners who want to move told the Associated Press that they cannot move until interest rates dip below 5%. Because so many people cannot justify trading a sub 5 or sub 3% mortgage for a nearly 7% mortgage. Tell me, does this make sense to you guys? Yeah, makes completely perfect sense. So we at AssumeList, and I have to be honest, we have a super genius as our CEO. You're looking at him. His name is Michael Lorino. He is a retired intel officer from the Pentagon. He reported directly to President Obama on a buku number of very fancy schmancy, highly classified intelligence projects. This man is a true super genius, and he built out this highly complex algorithm that now covers and delivers all of the on-market and off-market assumable properties for people just like you guys in 55 MLSs and 26 states.
Awesome. Thank you, Nora. So what we're gonna show you today is not theory. This is not some unproven technique. I and hundreds of agents around the country have literally doubled our business, our production volume, simply by introducing assumptions as part of my toolkit. And this is what we're going to teach you today. So we're going to jump right into it. Nora, let's start off. I know some of you have attended some of our trainings in the past. We apologize if we've covered some of these basics before. We want to just make sure we have a baseline of all the kind of key information, that the most important information that you need to hear. We're going to cover that up front. Also, it often takes hearing it 2 or 3 times to truly internalize it. But we're going to start off by covering the 4 reasons that 99% of agents have never done an assumption, even though buyers are dying to get this kind of solution in their hands, right? Buyers want to do an assumption. They want a house hack. They want to purchase a home at 2.5% interest rates, right? Let's face it, nobody's excited about 6.5% mortgages. But why aren't more buyers doing this? And it comes down to there are too few agents who have the skill set to help those buyers or sellers navigate the assumption process. So let me share my screen. We're going to cover the 4 pain points quickly, and then we're going to dive right into the platform and show you how it works and how you piece it all together and the language to use when you communicate with your counterparts, whether you're listing a property or representing a buyer. What is the language to use to get that home under contract?
Thanks so much, Mike. Okay, so we've already covered the fact that until AssumeList existed, it was really hard to find these mortgages. And all of the homes with assumable mortgages that you're going to find on AssumeList all have interest rates of 5% or below. The vast majority have interest rates below 3.5%. Now, you should just know all VA, FHA, and USDA mortgages are assumable. That is the law. What I like to tell folks is it's a federally guaranteed, legally regulated, squeaky clean process. For those of you who are really educated and really knowledgeable and you've done things like subject to and other creative financing, you know that those are very real options in the marketplace, but they can be quite a bit riskier. AssumeList is squeaky clean. The risk does not translate for assumptions. Assumptions are risk-free for the seller and the buyer, assuming that you know how to follow the process. So once you've found all of these assumable listings, what then? Well, a lot of the listings that you see on AssumeList, when you call the listing agent to inquire more and say, hey, I've got a buyer that's really interested, we'd love to see the property. Also, by the way, how would you feel about having the buyer assume this, this FHA 3.5% mortgage? Most of the listing agents are going to say the following words: oh, this property isn't assumable. Because the ignorance and misconceptions around assumable mortgages are tremendous. So the first thing we discover, and Mike, why don't we scroll down just a bit to obstacle number 2? The first thing we discover when it's time to take all this excitement and enthusiasm and all this new possibility, the way that you are an answer to your buyer's prayer, right? And your and your seller's prayer, because they have to go buy something new soon, right? The first thing you're going to encounter is just a total misconception about what homes are even assumable. The next thing you're going to encounter is people are going to say, wait a minute, what? No, those assumable mortgages are too risky, right? They can't work, right? And you say, actually, there's a federally guaranteed, legally regulated right to that, right? But most agents don't have this education. And honestly, most bank staff members don't have this education. We at AssumeList often find that we have to educate the assumption teams at the banks about what the regulations truly are. And that's part of what we'll get to when we talk about obstacle 4. The third thing you'll hear from agents when you go up to them is you'll hear them say, oh yeah, no, I know about assumptions. They're a nightmare. And in this regard, they're not wrong, because for so many people who have even one friend or one connection or have heard one story about an assumption, the stories that they hear are, it takes 6 months, it takes a year, you'll be in purgatory, bureaucratic purgatory for 7 months, and then you'll get a turn down, right? So we at AssumeList have built a transaction management team that has closed hundreds of assumptions nationwide. We have never had a turn down, and we have never gone longer than 60 days. So we have all kinds of educational materials for you, not only about the legal regulations, but about how we work closely with VA regulators, FHA regulators, and all of the assumption management teams at all of the major servicers to ensure that the laws are followed and the consumer rights of your buyers are honored. Okay, so that's part of your opportunity as an agent to show your incredible knowledge and expertise to your buyers, is to educate your fellow agents in that, so that we can help you get to the finish line and help your buyers get to the finish line in as many assumable purchases as possible.
And Nora, if I can just jump in real
Please.
quick before you talk
Mhm.
about cash gap financing.
Sure.
So one of the things that I use, one of the techniques that I use that works miraculously, is I market myself as being knowledgeable on assumptions. In doing so, through social media, email campaigns, whatever technique you use to get the word out about your expertise in whatever field or area that you focus in, buyers will start reaching out to you. Literally, most of them are buyers, but sometimes sellers who want to know, hey, is my home assumable? I'm a veteran. Can I list my home as an assumption? Right. The point is getting the word out that you have this skill, this expertise. You will see that your phone will ring. People will start calling you. Buyers will reach out to you because they are looking for somebody to help them navigate this process. They don't know where to go. Information they read online is factually incorrect. It's not really clear. They don't really understand it. So the easiest way to grow your business in 2026 is to solve the single greatest challenge that are facing homeowners and home buyers, and that is the affordability problem, right? So Brent talked about it. Nobody wants to take out a mortgage at 6.5% or 7%, but everybody would love the opportunity to buy a home at 2.25%, 2.5%. If you are known as the person that can provide that opportunity and you have the skills to navigate that process, then you will see your business grow. You will also use that as ways to grow your business in terms of growing your team, recruiting new agents, growing your downline. I know that's a big part of the EXP model. This gives you the tools to do that, and you don't even have to pay for it. It is provided to you free of charge through our partnership with EXP. Back to you, Nora.
You got it, Mike. So we've really tried to prepare you for what you're going to find when you go out in the marketplace, right? And by the way, this is your competitive edge. You're going to know way more. Just after this one training, you know way more than 99% of agents in your marketplace, right? And you're about to be able to teach that to 99%, to all of the people that you recruit, and then they'll know more than 99% of the agents in their marketplaces. We also have a Q&A every single day at 11 a.m. Eastern, 8 a.m. Pacific. So I lead that. It's live. You can register for it right on the AssumeList website. You can register for it right from your AssumeList dashboard once you're signed up. There's many paths. Mike, if you want to put, while I explain it, if you want to put the link to the Q&A in the chat, you can register for any day. We lead it Monday through Friday live. You can also bring other agents, buyers and sellers onto that Q&A, so you can have me and Mike directly explain and educate them, or explain things to them and educate them, so that you don't have to do it all yourself. So just wanted to make sure you guys know how devoted we are to live training and live handholding, so that you never feel like you're on this journey by yourselves.
And if you go to this link, and I'll go ahead and I'll post it in the chat right now, assumelist.com/areas-served, you can see all of the states and all of the counties in which we cover. Most of you, I think, on this call are in California. So if you click on the California tab, it will list the counties in California that our platform covers. Why we don't cover the entire state, or why we don't cover the entire country, is a simple answer, is because we can only launch in the markets that we have MLS access to. And anybody who's in real estate understands getting MLS access to MLS data is a very cumbersome process, a lot of compliance, fees, right? Certain MLSs, the rules vary broadly from MLS to MLS, and they don't necessarily like us sharing their information with the world. So we are in, I think, about 6 or 7 MLSs just in California. And as Nora mentioned, over 50 or 55 nationwide at this point. But you can see across the country, the states and the areas we cover right on that page. We'll go to the dashboard next, Nora. So once you create your account, we're going to, at the end of this, we'll pass out the code and we'll give you the instructions on how to get set up. We're just going to quickly walk through the platform, and we're going to run some real searches, live searches right now, and walk through what you're looking at, so you know how to interpret the data, how to make sense of it, and what language to use when you're communicating with your counterpart. Most of it we're going to focus on from a buyer's perspective, or representing a buyer. So reaching out to and calling listing agents about homes that you see that have assumable mortgages, and we'll cover some of the pitfalls that often apply or people experience when running searches. So Nora, here's the dashboard. You want to quickly just walk us through it as I scroll down?
Sure, absolutely. So in the dashboard, you're going to see all of the property searches, all of the properties you've saved, the searches you've saved, the properties you've shared. You're going to see your active buyer sub accounts. You're going to see how many accounts you have remaining. You're going to see the people that are your clients in the list of active sub accounts. You're going to see them ranked by how recently they were on AssumeList. And if you click on them, you'll be able to see every single thing they do, every property they click on, every search they run, etc.
Yep.
In fact, we're clicking on Luke now.
So this is an active duty service member that I just got under contract. Remember the three I mentioned earlier? I just got him under contract last night. $900,000 home with a 2.75% rate. Guess what? So AssumeList, I'm going to zoom in just a hair. We're diving right in. We're in the thick of it now. When you get registered and signed up, you want to get your clients in the platform. You're going to create an invitation link. We're going to add a sub account where they're going to be invited to join. When they start using the platform, they will see everything that you see, with the exception of they can't run off-market searches. But what you will see from your perspective is their activity. So this particular buyer, his name is Luke Chapman. He's a real person. He's under contract. This is his search history, right? I'm in Northern Virginia, Alexandria, Virginia. So these are the searches that this particular buyer ran. What's really cool is you can see their activity of how many times they've viewed a property. If they've added any comments about properties, love the backyard, kitchen is too small, don't like the bedroom side, whatever it is, you can see their comments too, and you can actually communicate back and forth with your clients inside the platform. So as they're running searches and they're making comments to you, you can see all that in real time. The cool thing here is this particular client viewed this property 91 times. Can you guess which home he is under contract for right now? It is 4213 Wilton Woods Lane. So we are under contract. And case in point, I was just monitoring his kind of usage and what he's searching for. And for obvious reasons, if a user or client is running the same searches and is going back to the same home over and over and over and reviewing it, is a clear indication that they are excited about that home. And you can see all that from their usage, right? You can see what homes they've saved. So if they favorited or saved the property, you can see the homes they favorited. Any searches that they've saved, you can see the searches that they've run, and you can run those searches and see what the results were. And if you recommend any properties to them, you can see those recommendations. So make sure that you don't lose track of, oh yeah, did I already send this to you before? You can see that from in the platform as well. Okay, that was just a quick divergent. So sub accounts, that's all part of the sub account feature. It's interacting with and providing value to your clients that they cannot get anywhere else.
Absolutely. And then under the sub account area of the dashboard is one of many ways to get to the AssumeList Learning Center. Now, the Learning Center is only for agents. Your clients will not be able to access the Learning Center from their client sub accounts. And if for some reason people don't want to work with you and sign that buyer agreement, and they just decide they've heard about Assumables from you and they're going to buy their own AssumeList subscription as a buyer, guess what? They still don't get access to this Learning Center. This Learning Center is only available to agents and agent subscribers, or specifically agent subscribers. So we have a whole number of fact sheets, videos, scripts, contract documents. We have so many different pieces that will help you at every stage of the Assumable process, every stage of the sales and business expansion process. Everything on here is downloadable and shareable. So any document that you see is a PDF that you can absolutely download. Any video that you see is a YouTube link that you can actually absolutely copy and send to someone else. So we've made it so that this is a rich treasure trove of resources, but we want you to be the source of the resources. We don't want AssumeList to be the source of the resources.
Yep. It's all about empowering the agents. And Nora, if you don't mind, if I can jump in, I want to point out two things on the documents and forms section that often comes up. One, if you are submitting an offer to, this is a little bit of strategy, so we're going to dabble in here real quick. If you're submitting an offer to assume a loan, you want to, and we implore you to include a VA assumption addendum or an FHA assumption addendum if the home is an FHA property. Those documents are included in the Learning Center. If your local jurisdiction has a standard form, through your board that you have available, by all means use that. Some local boards have them, some don't. We encourage you to use the one that we have. It's well written. It's been legally gone through rigor. It's acceptable and usable in all 50 states, and it's been used by all major servicers in the country. So they are familiar with this document. So you do need to include either VA assumption addendum or an FHA assumption addendum in your offers to cover the terms of that assumption that are not already provided or included in the base contract. The second thing I'll mention right on this is you will often hear, usually if you're representing a buyer putting an offer in, a listing agent or a seller is concerned about their liability. Well, what happens if the buyer defaults? Is my seller going to be liable for the mortgage, or will their credit be impacted? And the answer to that is emphatically no. And while you don't have to take our word for it, one of the documents, and there's several of these in here, is we have the VA assumption liability circular built right into this that you can literally send. This is the VA document, and it specifically says, if a liability is released, the seller is released from liability upon completion or settlement of that loan. So the language on how to address those concerns, certainly by all means, if you know it, but you can also send those documents to those agents if they want to verify what you're saying is true. And these are the actual VA forms or HUD forms for FHA, so that you are knowledgeable and you have all the source material to answer those questions when they arise. All right, let's roll right into the platform. Let's run some searches.
Yeah,
right?
let's run some searches.
And see what it looks like.
We can talk better about cash gaps when you're actually looking at real properties on the platform.
I'm going to quickly just talk through some of the basic features, and then we'll go into the run a search. So on the left-hand side is your menu, right? So we're in the property search tab right now. You know that because we see the map. You can view any shared properties, any properties you've saved. The client sub-accounts is where you invite clients to use the platform or view their activity. If you happen to find or think that there's a home that's missing from AssumeList that that is assumable, you can't find it, you can submit that as an add assumable property. My good friend Gary Meek does this from time to time. It is not because AssumeList data is bad. It's typically because when that property was purchased and recorded in the land records, there's usually an anomaly in the land records. It is common, not common, about 2 to 3% of the time, a home with a VA or FHA mortgage gets recorded with a conventional loan in the land records. So the public record search will not display that the home has an assumable mortgage. Or if it had a VA loan, say when they purchased it and those buyers subsequently refinanced, sometimes when it's refinanced, even if it was refinanced in the same VA loan, sometimes that tab or the loan type is lost when the refinance is processed and pushed back up through the local land records. And so it just says blank or conventional during the refinance. And so it drops off AssumeList because we have no knowledge of knowing that the home is assumable. Just know we're happy to add in properties that you know to be assumable if they're missing. In the grand scheme of things, this is only about 1 to 2, maybe 3% of the totality of all assumable homes kind of fall into this data anomaly category. They do exist, but we like to think, we're at 98% of our data is accurate, but anomalies do exist, so just keep that in mind. There are some other features in here. We're not going to go through all of them, but yeah, if there's a particular feature you want to see that's not in existence, you can absolutely click the add feature property. I'm sorry, add a feature request at the bottom, and we would happily look at building that out or supporting you with whatever your unique requirements may be for supporting your clients. All right, so let's run a search. Most of you are in California. I'm just going to do a random search, and this is a real search on AssumeList. We're going to run for Sacramento, right? So you don't have to spell out the entire word. Now, right at the top here, it says you can search by address, a city, a county, a zip code, a neighborhood, or a specific zip code, or I'm sorry, a specific address itself. So in this case, we're going to search for Sacramento County. There's the Sacramento City, and I'm going to click on, under counties, I'm going to click on Sacramento. Notice I only just entered the first couple letters of the location in which I want to search. You don't need to spell it all out. You don't need comma CA. It's pretty dynamic. And even Sacramento, it even lists out all the zip codes. So if you wanted to select the specific zip code, you can type the city name and it will tell you the zip codes for that city, or vice versa. You can enter a zip code and search based on zip code. So it's pretty dynamic way, the way the search bar works. So just clicking on Sacramento County, right off the bat, we see there are 223 assumable homes on the market today. Every property on this platform will have an interest rate of below 5%. In the map page, you can see the interest rates even before you click on the home, right? So we know the status, we know, we have some photos here if we want to look through them, but you can run additional filters, and this is a really powerful technique. When you are helping a buyer with an assumable mortgage, the purchase price is less relevant than the mortgage payment. What you're ultimately working towards is, what mortgage payment does the buyer want to keep their mortgage to within? And I usually recommend running searches that way. You may find, case in point, you may find a home that, just say, has a $3,500 a month mortgage. That purchase price could vary widely. Even just on this one page, we can see homes that are, $360,000 or $639,000. I'm pretty sure we might find others that are $700,000 or $800,000. Oh, here's one for $1 million. So if you set a cap of, the buyer wants to be under $1 million or under 800,000, and you set a price limit, you would be missing out on other properties that also have the same mortgage payment that your buyer is willing to spend. So keep that in mind when you run your searches. Other cool features is filtering based on cash gap. So you can run a filter based on keeping the cash gap below a certain threshold. And you can also set filters based on interest rate. So right off the bat, I have a $3,500 a month mortgage payment, less than a $250,000 cash gap, with an interest rate of under 3%. And we still have 77 properties that we can now cull through on the market, right? That we can look through. I'm going to just
Mike, let's open up 2531 Rice Alley. It's a $639,000 property with a $184,000 cash gap.
Yep, let's do it. So here we go. This home, I'm going to do two homes. This one is an FHA, and I do want to do a VA. So let me cover the VA first. I think that'll be relevant to probably more people. Let me just pull one up here.
It is and it isn't, right? Because I think there's a lot of questions about VA entitlement. We're already getting a few from Anne Marie. Great job, Anne Marie, being proactive. What's great about FHA assumptions is that any home buyer can assume an FHA assumption and no one loses anything, right? No one gives up anything. In point of fact, a lot of home buyers who would not qualify for an FHA mortgage because their income is too high can do an FHA mortgage, can do an FHA assumption because there are no income limits. There is no program requirement or qualification other than pure credit worthiness. So we have had plenty of, very savvy, very financially stable home buyers who said, wow, I can assume a 2.56% FHA mortgage. I wouldn't even be able to get an FHA mortgage in my home county because I make too much. But I can get this low rate and have it be an FHA loan. That is so neat. And they get really excited because as long as they're willing to live in the property for the first 12 months and they are credit worthy, they're good to go.
Awesome. Thank you for that, Nora. I'm going to just go through the piece of information that's available to you and your clients for every single assumable mortgage on the platform. So right off the bat, we have the property status, and we update our website, our platform, synchronized with the MLS about once an hour. We're trying to get that down to within a few minutes, but right now it's about every hour we'll update. So if price changes, if the status changes, it's about once every hour. We also see days online. So this property was listed just looks like today. Property address, the list price. the cash gap, right? So this is really powerful because we know what the loan balance is. We actually calculate this in-house. A lot of what you're looking on this page is internal to AssumeList, which means this is all kind of proprietary data that we create, that we generate, that we produce. This is not stuff, generally speaking, that you can find online, with the exception of probably the loan type. Sometimes that's available through tax records and so forth. But because we have the loan balance, and of course we know the sales price, we calculate for you the cash gap. And that's what enables you to run that search filter based on the cash gap. Why this is really important, because now you have a basis to know whether this is a viable home from your buyer standpoint. We're going to talk about the mortgage calculator here in just a second. I want to go through a few other terms here. Loan type, FHA, interest rate. We also calculate for you the approximate interest rate for every single assumable home. Interest rate is not publicly available. Only the homeowner and the lender know what the actual interest rate is. We reverse engineer the mortgage. We have a lot of really fancy software that figures it out. For the most part, the interest rate you see on AssumeList, the actual rate will be about plus or minus 0.25% from that. I would guess this particular property most likely has an actual interest rate of probably 2.5%. It could be 2.25, could be 2.75, but probably 2.5. This home does not have a 4% interest rate. This home does not have a 5% interest rate, right? So this is a really reliable way to know what you're looking at long before you even reach out to the listing agent or schedule a showing. Mortgage payment, we know what the mortgage payment is. So again, what is my buyer going to pay if they were to assume this home? The initial loan amount, less relevant for FHA. We're going to talk about that with VA. The other cool thing we do give you is the remaining mortgage. Remember, with an assumption, the buyer is picking up the mortgage exactly where the seller is left off. So in this case, this owner bought this home, right? Purchase date, we show you the purchase date, February of 2021. They did not refinance. If they had refinanced at some point, that refinance date would be shown. Bottom line, though, is that loan initiated in February of 2021. A buyer who would assume this loan is assuming a 24 and a half year mortgage, remaining mortgage. They are not buying a home with a new 30-year loan. It's important because, as you all know, interest on a new mortgage, right? The mortgage payments for the first, if anybody's seen an amortization table, right? The first few years of a mortgage payment, it's like all interest. Well, in this case, this current owner has already paid a vast majority of the interest. So a buyer assuming this home with a 2.5% rate, the individual mortgage payment, there's a much greater percentage of that payment going towards the principal. Another benefit to doing an assumption aside from the lower mortgage payment itself. Okay, I'm going to, let's quickly talk about the mortgage calculator. This home, as we said, has a roughly 2.5% mortgage. We give that to you. Right off the bat, on the right-hand side, we tell you, and we kind of guess what current interest rates are for the local market. The software automatically updates it as rates move up and down. It may not be the exact rate that your client could get with a new loan. Let's just say they could get a 6.25%. Great, we'll just plug in 6.25%. So now what we have is an apples to apples comparison. If your buyer were to pursue the assumption, what their mortgage payment would be, versus if they were to take out a new loan, what their mortgage payment would be. And we tell you what the monthly savings is. You really didn't have to push that single button, other than if you wanted to update the exact interest rate they would get. This buyer would save about $740 a month by doing an assumption on this property. Pretty compelling amount of savings. We break out that mortgage payment further down below. Automatically includes property principal interest and property taxes. We don't guess what homeowners insurance policies are. They could vary widely between condos and single family homes, beachfront properties, flood zones, all kinds of different variables. If you just happen to know this home, roughly has $150 a month for a homeowner's policy, we will immediately calculate that in, and now it's reflective of a true PITI, principal, interest, taxes, and insurance. And in this case, since it is FHA, we do calculate for you the mortgage insurance on this property as well, and that is built into the monthly payment. In this case, there's also a condo fee, so we show you that as well, though that is obviously separate from the mortgage payment. Let's say, Mike, my buyer doesn't have the $84,000 available for the down payment, but we're interested in doing a second mortgage to cover that cash gap. Generally speaking, as long as the buyer has 10% down, so you can't do 100% financing, you have to show up with at least 10% of the purchase price. So 10% of the purchase price a buyer generally needs to come up with, and they are able to borrow the rest through a second mortgage. Well, what is that going to cost? And what's that payment? Blah, 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 right? So easy. We've already built that out. Just hit the 10% button. Boom. Instantly calculated. Down payment, 10%, $63,900. Guess what? It's 10% of the purchase price. Already built out. Below that, it says the funds financed by the second mortgage. We automatically calculate what the second mortgage amount is and the second mortgage payment. In this case, $751. Moreover, now that we know the second mortgage payments, and this payment is built into our platform, which mirrors the lenders that the lender partners that we work with, their mortgage program. So it is exactly the second mortgage payment that you can expect if you were to apply for a second loan with one of our lender partners. More importantly, we now provide you with what's called a blended rate. So anytime you have a buyer that needs to use a second mortgage and you need to understand, well, how is that going to impact the savings, or what is that going to impact my buyer's ability to qualify? What's the total payment? We provide that for you with a literal click of the button. Remember we said the original interest rate was right about 2.5? With the second mortgage, that creates what's called a blended interest rate, which is the equivalent interest rate of a new loan at right about 3.88, 875 would probably be what you would be used to seeing, with a 3753 mortgage payment. So that is effectively the first mortgage, the loan that's being assumed, plus the second mortgage combined together is a $3753 a month payment. And more importantly, how does that relate to a new loan? So the question that you would need to, or the conversation you need to have with your client is, okay, if we get a second mortgage, is there still savings? Is the buyer still saving compared to taking out a new mortgage, because they're obviously having to take out a second loan, and second loans generally do have a higher interest rate. In this case, remember, we're still apples to apples. 10% down is 10% down on a new loan, is 10% down on the assumable loan. They are still saving $729. It's almost unchanged whether they pay the cash gap or whether they do a second mortgage, just because the way the numbers work out with the interest rates with the new loan. So to me, this is a very viable assumable property. Even with a second mortgage, a buyer would still save over $700 a month.
Absolutely. So, Mike, I just want to add a few nuances, and then I think we should give out the code.
Let's do it.
While people are getting their EXP, their new EXP AssumeList accounts online, we can talk about VA entitlement and some of the nuances of VA entitlement. So just a couple of notes on this. So your buyers who have buyer sub accounts, which, okay, get them to sign those buyer agreements. Do not give out buyer sub accounts without signed agreements, my friends. This is just as someone who has coached thousands of agents. All right. We want you to be successful here. So when your buyer is going, and running all their searches, they're going to be able to see this mortgage calculator on every single property, and they will ask you questions like, "Oh, is it going to change my mortgage payment, and I'm suddenly going to pay the bank a new payment?" No, this is a theoretical calculator that takes the two different payments that are paid to two different institutions, because I promise you, no bank has ever wanted to make an assumption easier when they had to keep a 2.5% or 3% loan on their books. So we actually have to help your buyer bring in a second mortgage that's actionable and available for an assumption purchase. We have to help your buyer bring it in from a different institution. And that's what we do. And so we take the second mortgage payment, which is down there at the bottom of the calculator, and we add it to the primary mortgage payment, which will come out of their account as two separate payments if they do auto pay, right? But we add them up and we do this comparison, and we run a bunch of, mathematical calculations, which I'm happy to explain maybe towards the end after everybody's signed up and asked other questions, just to help the buyer have a concept of how much money they're saving and how far below market rate their blended or their combined interest rate really is. So we find this is a really exciting, really attractive tool for buyers because it really makes the savings very tangible and very visible. Okay. So now I'm gonna put the code in the chat.
Yep,
Mike is
please
gonna
do.
open an incognito window.
I will, and I'll walk everybody through how to get signed up literally right now. You can do it as we're talking. So Nora, have you got it pasted in there?
Yep,
Okay, very good.
I just sent it to you instead of everybody. Hold on. There we go. So here is the registration code. Obviously, we're so glad you guys came on the Brent Gove training. So we wanna honor Brent in our code. Christy, it's different for different buyers, but we've seen people do assumptions with credit scores as low as 690.
No, 580, as low as
Oh,
5. It's
580,
basically the
really?
same. So the answer is the same guidelines or underwriting guidelines to get approved for a new VA or a new FHA applies for assuming a VA or assuming an FHA. So whatever the lender guidelines are for approving a new mortgage applies to an assumption. I've seen buyers do assumptions as low as a 580 credit score. Usually it gets a little dicey if it's 560 or below, but you generally want to you want to have at least decent credit, right? Decent credit. The registration code for today is GoBrent26. So just so you know, the code expires at midnight tomorrow. It's a 2-day code. If you try it over the weekend or next week, it will not work. It is intended to expire because we want to make sure that people that are attending it are the ones that are registering it, and it doesn't get emailed to a team of 30 people, and then a month from now, people are still using that code, and they've never attended any training. So when you go to AssumeList.com, our homepage, AssumeList.com, at the very top in the banner, you will see the Get Started button. Just hover over that, and you'll see that I have an eXp license. Click on that button. You will enter today's registration
So
code.
Mike, just hold on one second. We are dealing with real estate agents. 97% of real estate agents have ADHD. Can we go back one? Can we just stay on that? Okay, everybody. I hope everybody is going to AssumeList.com. I had a lady call me today. She said, Nora, I'm on my eXp website. I can't find where to get into AssumeList anywhere. AssumeList.com. Okay. We're going to hover over Get Started, not log in. Okay. There's two options. One says AssumeList account, one says eXp account. Go to eXp account. Please speak now or forever hold your peace if you did not see what we just did.
Thank you for that. That's so important. At the very top of AssumeList.com, you'll see Get Started. You can click on the Get Started, and it says eXp account. I have an eXp license. So it does work on mobiles. If for some reason it's not working on yours, I don't know, it might be something unique on your particular phone. Once you get to here, you enter your registration code. You're going to be asked to provide your primary email address. That's the email address that you want to use for your login, your login credentials, and also the email address that you want to use to communicate with your clients. Set your password. Enter your primary state and license number. You have the ability to add additional states later. The more states you add, if you're licensed in multiple states, it gives you the ability to create sub-accounts in those additional states. There is no limit on where you can search on your account when you log in. Licensing is only for your ability to support clients in other states. Obviously, it would make sense if you're not licensed in Florida that you would be able to support a buyer purchasing a home in Florida. So there's kind of some legalities here with how the system is designed. The bottom piece here is the most important. Your official eXp email address. This is how we verify that you are a eXp agent. This prevents other agents from other brokerages trying to use eXp licenses and seats. Enter your eXp email address once I'm not a robot. And then you hit the register now button at the bottom of the page. It will send your eXp email a link, a verification link that says, please click here to verify that you received it. Once you click that verification link, your account is active. You can just log right in and start using AssumeList. You are good to go. There is no credit card information. There's no payment information. Your account is active and ready to go.
So I see a bunch of questions in the chat. I see a question from Mohammed. I see a question from Christy. But I think, Mike, what we should probably do is get into some of the nuances around VA entitlement.
Is that where a lot of the questions are right now? I'll cover that as quickly as I can. And if we run a little longer, I think we have, an additional 30 minutes on this Zoom session, which we're happy to continue on. If you need to jump off, feel free. But if you want to stay on, we're gonna get into some of the more, we'll call it the deep end of the pool, is what I like to say. So if you really want to learn about VA entitlement, how to have those conversations about entitlement, split entitlement, we're going to talk through that. And then Nora is going to continue to answer questions in the chat. But we'll stay on as long as we can until the Zoom session expires. I think we've got at least another 30 minutes for those that have the time.
Absolutely. And if you want to be with us a different time because you have to go, be sure to register for a live Q&A. I just put the link in the chat, homes.assumelist.com/learn. Because there's so many tools we've built out for you. There's so much. There's off-market mailing tools. There's a VA entitlement calculator. There's so much to learn. So
skip tracing, shared links, branded landing pages. There's a ton of stuff that we could cover if we did like a 3-hour session. All right, let's cover one of the most important topics is VA entitlement and how a veteran or non-veteran can assume a VA loan, right? So right off the bat, no, you did not have to be a veteran to assume a VA loan. Investors, non-veterans, any qualified buyer can assume a VA loan. The benefit for doing so is when a seller, so the requirement for a non-veteran to assume a VA loan is the seller has to be willing to leave that portion of their entitlement that's tied to the property. They have to leave it with the home. When they agree to do so, and there's a number of scenarios and cases in which they often do, and about 1 out of 4, 1 out of 5 sellers are willing to leave their entitlement. So it is a very common practice. When they do so, then any qualified buyer can assume the VA loan. This is where my investors come in. I have investors literally from all over the country that call me and say, Mike, I want to buy a home with a 2.5% mortgage. For obvious reasons, it's a whole lot easier to cash flow an investment property if they got a 2.5% mortgage than taking out a DSCR or an investment loan at 7.5%, 8%, 8.5%, right? So obviously it's a lot more advantageous to do so. So that's where that comes into place. The only type of loan that can be assumed where the buyer, the purchaser, can immediately rent out the property or otherwise not live in it themselves is a VA loan when the seller leaves their entitlement. FHA properties or VA loans where the buyer uses their own entitlement, those two scenarios have to be owner occupied once you close. All right, so all FHA assumptions, the buyer assuming the property has to live in the home, occupy it within 60 days of settlement. Additionally, a buyer can only own a second FHA property if it's more than 100 miles away from the first one. So FHA properties is really not a thing for even somebody who wants to buy a home, live in it for a year, then drive down the street, buy a second home with a 2.5% mortgage, and then convert that to a rental property. It is a little bit more complex. FHA rules are really meant to be, owner occupied type of a loan program. So you can own as a buyer and owner multiple FHA properties. They just have to be greater than 100 miles from each other. Otherwise, that loan or that assumption won't go through. That restriction does not exist for VA. You can have a buyer, they can close on a VA loan, the very next day put an offer in for another VA home right across the street, rent that one out, put another offer in a week later, get that home under contract. I have one investor I'm working with right now who has purchased 3 VA homes in the last 4 months. You can't apply to 2 homes at the same time, but as soon as you close on one, you can put an offer on another. Location agnostic, doesn't matter. They can all be rented out. Really, really powerful tool. Okay, let's talk about entitlement. I'm going to do a quick little blurb on how the entitlement works. Every veteran, I'm just going to use this property that we had up before as an example. Every veteran has a limited amount of entitlements if they own multiple properties. If they own one property, it is unlimited. Meaning that a buyer like myself, if I'm a veteran and I want to purchase a home with a new VA mortgage, and this is the first home I'm buying with my VA loan or my VA entitlement, As long as I can qualify for the mortgage, it doesn't matter what the purchase price is. If I can qualify for the loan, I can buy that house. Entitlement, split entitlement really comes into place, or the limits, the caps come into place if a veteran wants to own multiple homes with their VA entitlement, then there's a limit that applies. That limit varies from county to county across the country. Generally speaking, that is $832,000. And let's see here, if I show you this page real quick, there's a link right on our website that you can go to, and you can see a map of the US. Everywhere that's gray is $832,000. The areas that have the different colored shading, the maximum loan limit increases. So for let's see here, Solano County, 832, Contra Costa, 1.249, Alameda County, 1.249, San Joaquin, 832. So it's a little bit of a kind of a mixed bag in kind of that central California market. All of Southern California, the coastline, there is an elevated levels of entitlement available. Colorado, Northern Virginia, my market, New York City, right? Areas around the country, Hawaii, Alaska, also have higher entitlement numbers. Why this matters is because every property on AssumeList with a VA loan, you will see this VA entitlement calculator. This VA entitlement calculator is intended to be used when you have a buyer who wants to put a non-veteran buyer who wants to put an offer in to assume a VA loan, and you want to be able to have a conversation with the listing agent on whether the seller is able to leave their entitlement without being impacted with their ability to take out a new mortgage or buy a new home with their remaining VA benefits. And where this comes into place is I will often call a listing agent representing a buyer and say, hey, I've got a buyer interested in putting an offer in on your property. I see it has a VA assumable mortgage. Have you had the conversation with your seller? Are they willing to entertain an offer to assume the loan? And if I get the response, no, my seller isn't interested in doing an assumption. They need their entitlement for their next purchase. That's the common response I get. And my answer to that is, okay, well, are they buying a home that's priced over $1 million? Well, no, they're gonna probably buy a $500,000 or $600,000 home. So then I would say, just looking at this property here, I would just say, okay, well, what if they have over $900,000 of entitlement remaining? If they leave their entitlement with this property and they're not impacted or encumbered in their ability to take out a new VA loan, so they can proceed as planned and they're not impacted in any way, does that change the calculation when they would be willing to leave their entitlement with this property, knowing that it's not going to impact them at all? And usually the listing agent at that point don't really know how to respond because they've never even heard of this before. So then they're trying to figure out ways, well, what I'm telling them has to be false, right? Or what I'm saying can't be true because they've never heard of it before, therefore it's not true. Well, what we do here on this platform is we give you this little summary that tells you what the seller's maximum buying power is if they were to leave the entitlement with this property, and what they could do next and what they can buy next with their remaining entitlement. Couple things to keep in mind. One, where that buyer moves to has an impact on where the maximum entitlement is. So Sacramento County, for example, has a maximum entitlement of $832,750. That is the lowest there is nationwide. So no matter what happens, this seller will always have at least $933,000 of buying power for their next home purchase if they left their entitlement with this property. And this is just one example. Every home you see on AssumeList, this is automatically calculated for the exact numbers for that scenario. If they were to move to another county where the entitlement is higher, then this number will go up and their buying power will increase. The other cool thing, and as I'm going to download this PDF report. Every property also has a PDF report that gives you a really informative way to have a conversation with the listing agent on what how the calculation works, how the numbers work for a entitlement, for leaving their entitlement and having the buyer assume that loan, a non-veteran buyer assume the loan. And this is what that report looks like. This is custom created for this property, right? So I'm going to quickly walk you through this, and then you're going to be educated to know how the numbers work so that you can now educate other agents. This is what's going to win it for you, win the deal for you when you have a buyer that wants to assume a loan that doesn't have their own entitlement and you want to assume a VA mortgage. This will win that discussion and will give that listing agent ammunition to engage their seller on what those options are with factual, fact-based information. So what this does is it breaks it down to two numbers, right? And we show it at the top of the page here, which was the same numbers that we showed on the website. The first number is the remaining entitlement they have, just base entitlement. So we knew it's $832,750 for Sacramento County. That was just the example of the property that we found. The entitlement used in the current property is $346,000. We know that because we know what the original loan balance was. So we deduct, or we do the math here, and we were left with remaining VA entitlement of $486K. That's what that buyer has. What that means is if they wanted to go out and buy another home, they would have the ability to purchase another property with a new VA mortgage up to $486,000, zero down, 100% financing, no down payment. That's what the limit allows them to do in this county. What we also calculate is this particular homeowner is going to walk away with, right, the proceeds, the cash gap. And this home has a cash gap of $138,000. So what we do is we calculate what the sale price is based on list price. We subtract out brokerage compensation and closing costs. We subtract out the loan payoff. We have all this information. So we know what the net proceeds are. What is the amount of money the seller is walking away with deposited into their bank account once they sell their property? And in this particular home, it's 111 grand. It may be $1,000 difference here or there, but for the argument's sake, this is close enough to have this conversation. What this does translate to is it gives us the ability to calculate that homeowner, that seller's additional purchasing power, what they could buy above and beyond their remaining VA entitlement. And without getting too far into the nuts and bolts of this, is all VA loans, the government guarantees 25% of the mortgage, right? That's the VA guarantee. What's the purpose of a VA loan? Guaranteed 25% loan, will never be in default. So any amount of purchasing, a purchase price that a borrower with limited entitlement wants to purchase above that amount, they just self-guarantee the difference. So in this case, if a buyer wanted to buy a home that cost $586,000, they only have $486,000 of entitlement, then they have to put 25% of that difference as a down payment. So 25% of, let's calculate the difference. The difference between 586 and 486, 100 grand. So, and then 25% of that is $25,000. So for a $25,000 down payment, this buyer can purchase their next home with a VA mortgage priced $586,000. But hold on, this buyer is walking away with $111,000. So all we do is we run a quick little calculation. For every dollar down payment that homeowner, that seller, future buyer puts as a down payment toward their next home, for every dollar down payment, they get $4 of additional buying power. So we know using their proceeds, which most sellers will use the proceeds of the sale towards the down payment of the next home. They don't have to use all of it, but for just the calculation purposes, they are able to. They are capable of doing so. They get an additional $446,000 of buying power above and beyond their base remaining entitlement. And that's what it shows here at the bottom of the page, right? Remaining entitlement, 46. We add in the additional buying power, and now we get a total maximum buying power of $933,000, which is to say that if the seller leaves their entitlements with the property to a non-veteran, allowing the non-veteran to assume it, that owner, that seller, has the ability to buy a new home with a new VA mortgage up to $933,000 without impacting them one bit whatsoever. So hopefully that makes sense. There are certainly different ways to kind of slice and dice and look at it, but I'll pause there. Nora, is there any questions that anybody wants answered on entitlement?
There are some other questions that are not about entitlement that I would love to cover, but let's pause and talk about entitlement. I know that Mike talks about it really quickly.
Yeah.
And
this
we
is you're
had
not going to learn it in one fell swoop. This is why Brian has attended this class 3 times, and I would encourage you to come
yeah.
back. This is really just meant to provide
Yeah,
baseline
this is
understanding.
your intro. We also have videos on the Learning Center about this, and I think Mike, we should probably post a few more. But what I will say, guys, is we've had a lot of great questions in the chat, and I wanna attend to some of those because some of those are just easier to deal with verbally than trying to type out all the things. Does anyone have anything they want to ask about entitlement before we go to some of the questions in the chat?
And at this point, if you wanted to just jump in with a question, take yourself off mute. You're welcome to do so.
The one thing I do want to make sure I say about entitlement, so the amazing thing about VA assumptions is that if you can help a seller and a listing agent get comfortable with understanding the way split entitlement works, right? Because really, the veteran has a lot of flexibility with the ability to use entitlement as long as they have $1 of VA entitlement left, right? They have a tremendous amount of flexibility. The neat thing about a VA assumption, if the veteran is willing to leave behind entitlement, two things. One, any VA assumption where the veteran is willing to leave behind the portion of their entitlement tied to the property can be assumed by an investor. So investors love VA assumptions because there's no mortgage insurance, because they get to have a cash flow positive property, right? So investors love it. Investors cannot assume FHA or USDA homes without living in them for the first 12 months. And even a veteran who uses their own entitlement to substitute for the veteran seller's entitlement, thereby allowing the veteran seller to recap or recapture their entire entitlement, even that veteran buyer has to occupy the property for 12 months because all government-backed mortgages are part of home ownership programs. Okay, now home buyers who are not VA love VA assumptions because there's no mortgage insurance on VA mortgages, which is unusual, right? There's mortgage insurance on FHA and there's mortgage insurance on conventional loans up to 20%, right? FHA mortgage insurance is forever, right? So there's no mortgage insurance. The interest rates are generally lower than the rest of the market was at the time, right? So investors love it, home buyers love it. So this is why entitlement and being able to help people get comfortable around splitting their entitlement is such a crucial piece. I know Tom had asked some VA entitlement related questions in the chat. So Tom, why don't you come off mute and talk to us?
Thanks, Nora and Mike. Really appreciate you guys doing this. You've forgotten more about this stuff than I know. So pardon my ignorance. First of all, not to overstate the obvious, but Mike, correct me if I'm wrong. Just because a property shows up on AssumeList, that does not mean that the seller is willing to leave a portion of their entitlement. And based on the scenario, am I wrong about that, first of all?
You are not only correct, but actually, I cannot tell you how often we call, the listing agent for a property and they say about a VA property, what are you talking about? This home's not assumable.
Yeah,
so much ignorance.
There's really no way, and we get this question a lot. People will sign up, particularly home buyers that will sign up and use our platform for a couple of days or a week, and this is not workable because it doesn't tell me which homes the sellers are willing to leave their entitlement. That's like saying we want a list of all homeowners that are left-handed. Like there's no way to know that, right? It is a personal decision that a homeowner makes at the time the offer is submitted, or at the time that agent is engaged with that listing agent. And I've had many examples where I've called listing agents who have talked with other buyer agents and said, no, I've already told so-and-so that the home isn't assumable. I'll call up, and not only will I find out it is assumable, I'll put an offer and I'll get it under contract because I have the ability to educate the listing agent, educate the seller, to have them understand what's involved. And through knowledge, they are able to make a better decision. And that is usually the difference between success and failure. So there is no database that you can just look up to see who's willing and who's not. It's, are you able to call and have that conversation and figure that out and work with them and massage that process so that they feel comfortable with it, and that creates the opportunity, right? It creates the opportunity.
So it sounds like part of our biggest obstacle, again, correct me if I'm wrong, is not just identifying the property, but finding out how much of the entitlement is available. And it looks like based on your calculation, we can see how much of the entitlement is available. The real question is how much of that remaining entitlement is the seller willing to leave behind? And it sounds like
it's not exactly how much of the entitlement are they willing to leave behind, because they don't have a choice. It's not some percentage of that entitlement. It's the entitlement equal to the initial loan amount that is tied to the property. So it's a yes or no question. Does that make sense, Tom?
Okay. That part does. But you were talking about it. Okay, the question then becomes, correct me if I'm wrong, is the seller going to take all their entitlement with them to purchase their next property? Or are they willing? I guess that's a yes or no question.
So let's just back up a few steps. Mike, will you please share your screen? And we're going to walk through this just a little bit more slowly, because I know Mike covered it, but I know that when it's brand new information, it just goes by so fast. And
right.
just to clarify, I think I had to hear Mike explain this about 27 times before I had it. And so that's why I like to go nice and slow. So Mike, why don't you...
I found another random VA home.
Fabulous. And
do you want me to...
So Tom, the amount of VA entitlement, do you see where it says initial loan amount? Mike, you want to highlight initial loan amount for me? There we go. So we have public data for every single property that tells us exactly what the initial loan amount is.
Okay.
So that is not debatable. It is not estimated. So that we know for a fact, because we know VA regulations inside and out, right? We know that the amount of the veteran owner's entitlement that is tied to the property is equal to that number, the initial loan amount number. Okay. Now, there are some vets who have a misconception. We encounter this all the time, literally every day. They say, oh, I only have $345,000 left on my property, so that's all the entitlement I have tied up in my property. And I say, sorry, sir, you are mistaken. The entitlement that is tied up in your property is equal to the amount of your initial loan amount. There is no amount of payoff of the mortgage that reduces the entitlement tied up in your property until the VA loan is completely eliminated, paid off, etc.
Yeah, it's fixed amount. Once that entitlement is used, it stays with the property until it's refinanced, paid in full, or the home is sold.
And refinancing, if they stay VA when they refinance, now there's simply a different total number, right? Because it's the refinance loan amount that is the amount tied up in the property. So if they have a refinancing and they stay VA, it'll be equal to the refinanced amount. And you'll see examples of that on our platform. You'll find homes that were bought in 2018, 2019, and were refinanced in 2021,
in 2019 and refinanced in 2021.
There you go. So there you go. So that
the loan amount is the 2021 refinance loan amount. So as they pay their mortgage down, in this case, the loan amount today is $345,000. It doesn't mean that their entitlement used is $345,000. No. It is fixed based on that original initial loan amount.
Yes. Well, or in this case, it's the refinanced amount.
Which is why, Nora, you say that it's a yes or no question. It's not a matter of how much they're willing to leave. They're either willing to leave it or they're not. If they need it for their next home, they won't leave it. If they don't, then they'll leave it.
Now, whether or not they need it for their next home is the great debate. Because we know that they have leftover entitlement. Now, are they using that leftover entitlement in a different property? That's something we can't know. Right? We don't have like spies that are going and digging up all these people and figuring out, oh my gosh, so what other properties do they own? And occasionally, well, darn it. I know, right? Occasionally you will encounter a seller who says, well, no, I own 3 other properties. I've got VA loans on this, VA loans on that, right? And you'll say, oh, okay, so you've got none left. Does that mean you're not going to buy another one? Right? Sometimes if they own multiple properties, that actually means they don't need to buy another property, right? So there's many reasons, like there's many paths to, you're not going to need this particular amount of $396,000 of entitlement. The most common scenario is the one we built the VA entitlement calculator for. The most common scenario is, in 80 to 90% of cases, this VA owner bought this property and it's the only property they own with a VA loan. If it is the only property they own with a VA loan, then yes, we can accurately estimate their remaining entitlement based on the county they will be buying in next. And you can actually change the county in the VA entitlement calculator. So the software always presumes, oops, sneezing on the truth.
Yeah. So if you go from Sacramento to,
Excuse me.
Bless you.
we said
you.
Placer has an updated entitlement, right? So it goes from Sacramento. Oh, that's 832 as well. What's the other county? What's the other county?
El Dorado County.
Contra Costa.
Let's do Contra Costa. Contra Costa's a good one. So they're moving to Contra Costa from Sacramento, right? That's nearby, isn't it, next door?
Near
Close.
enough. Close enough.
Yeah. So Contra Costa. So they're going from a county where it's 832,000 to a county where it's 1.249. So their remaining entitlement just jumped from 463,000 to 853,000. So now their buying power just went up by the dollar for dollar that commensurate amount. So where that seller is, so sometimes we'll ask the listing agents, hey, is the buyer staying in the same area or are they moving somewhere else? Oh no, yeah, they're moving to Contra Costa. Great, I'll just plug in Contra Costa and that gives me more ammunition for the argument because it further solidifies the position here, right? So the initial loan amount doesn't change, but the available entitlement, the remaining entitlement, let me just zoom in a little further, went up just based on the county which that homeowner is moving to, right? So the decision is the seller going to be impacted by leaving this amount of entitlement with the property? It's not more, it's not less. That's the number we're talking about. Do they need that number? And if you read this text here, right, if a non-VA buyer assumes this mortgage, the seller may have enough VA entitlement to purchase their next home with a new VA loan, even after leaving behind the portion of their entitlement tied to this property, which is this number. And with this off to the right, before you even download the PDF summary is all the math, right? That's the, how did you figure this out? Because there's no other place on the internet you can go to. There's likely no lender that you can contact that will calculate this for you and give you the answer that you're looking for to help you have this conversation with a listing agent, a prospective listing agent. And what this tells us is if this seller, assuming this is the only VA loan that they have, and Nora's correct, about 90% of homeowners, this is correct, that this is the only home they have with a VA mortgage, they could leave that entitlement with this property, allow a non-veteran buyer to assume it, and they would have the ability to go buy a new home at $1.5 million with their remaining entitlement. So my question to the listing agent is your homeowner who's currently living in a $500,000 home, are they going out and buying a $1.5 million home next? And we all know probably not. I mean, most people are not tripling the value of their house when they move from one to another. So I would then say, okay, so if your seller is not impacted at all, not limited in any way from being able to use their remaining VA benefits, no impact, would they be open to leaving their entitlement for my non-veteran buyer? And we're going to put in a full price offer. It's going to be aggressive, and we're going to make it worth their while because the buyer is going to be saving, $600 a month in this case, $587 a month, which is not bad for a $540,000 home. That's a reasonable amount of savings. So,
Tom, Mike, slow down. Tom, did you want to add something?
Mike, you're doing great. Thank you, Nora. Here's my only silly question, and I'm just thinking out of the box. This is probably not possible, but it'll make sense to you. If Mike, in the scenario you just gave, they're moving to a county where their entitlement now jumped to 1.5 million. Chances are they're not going to need that amount. The amount that they're going to leave behind on this is only 340 something, so it's less than 500,000.
396, my friend. 396. Don't get confused.
yep.
345 is their remaining loan balance. Remember, it's always the amount of the refinance or the initial loan.
The initial loan. Okay, got it. Thank you. I'm going to round it to 400,000 just for my simple mind.
Love it.
So 400,000 is what's being left behind. 1.5 is what's available. They're going to buy a home at 500,000.
Great.
Right. So with the two, my simple mind says there's 600,000 left available between what I'm using, what they're using, and what they're able to use. Can my client as the buyer use more of that entitlement?
No.
Okay.
No.
That's what I was wondering.
The only entitlement that's available, so whatever entitlement that was assigned to this property when that loan was issued,
Originated.
when it was originated. That origination could be the first loan or refinance. When that loan was originated, that entitlement is fixed to the property, cannot change. There is no way to adjust it. It's an all or nothing approach, meaning the seller leaves it, the buyer assumes that remaining entitlement, or the seller takes it with them and you have to take out a new loan. Or if the buyer is a veteran, then they would assume this entitlement, right? Substitution of entitlement, SOE is the term. So a veteran buyer could assume this same mortgage, and the amount of entitlement that buyer would need, that veteran would need available to do the assumption, would be that 396, that 400K. So even a veteran who has entitlement, who wants to do a substitution, can only do that substitution if they have that $400,000 available themselves.
Right. And they would only do a substitution. If I was a veteran and I was a buyer, I could qualify for that with my own. I wouldn't need the seller to leave their entitlement because I have my own.
It makes it easier, because if we say, 1 out of 4 sellers are willing to leave their entitlement, what that means is 3 out of 4 sellers are not. So
right.
Obviously,
so for us, that's the frustration. Because I got to be calling Gary Meek, the listing agent, and saying, okay, Gary, is your seller willing to leave it behind? Yes or no? And if Gary's not familiar with assumptions, then now I've got to educate Gary on the process.
You got to educate
That's
Gary.
how you earn your commission, buddy.
Hey, let me tell you the secret sauce, Tom. For me to go through that trouble and have those conversations, I charge a 0.5 point higher in commission structure for my buyers, because I am using that skill and that little niche that only I have to provide that service to my clients. And trust me when I say, they are happy to pay that additional fee because they are thrilled to get a 2.5% mortgage on their next home purchase.
I was hoping that you were going to say, and the best part that we're saving for last is that for those agents who use AssumeList, your buyer commission is automatically 4%, and buyers and sellers have to sign that going into it. So they already know.
They already know.
Premium for our expertise.
We advise
You
you
can
to do that.
Choose whatever structure makes sense for you. I have in my buyer agreements, I have a certain fee for standard purchases. I add a 0.5 point whenever I do an assumption. They agree to that up front.
I love it. Love it.
Okay, we have so many more questions in the chat. Before we get to those questions, I need to put, we have made poor Jennifer Meek and poor Gary Meek wait so long. Got to get them to come off mute and make their beautiful voices heard. We are so blessed to be partnered with the most amazing leaders at eXp. Gary and Jennifer Meek, would you please come on down?
I appreciate you guys doing this for us. I personally have closed 10 assumptions in the last 12 months. And on top of that, just so you guys know, this is such a great value add. I've actually closed 5 other deals that ended up wanting Assumable, that ended up buying a regular house because they couldn't find the perfect house. But because I added this value, I was able to secure that client over many other agents. So there's some value add here, and Mike and Nora are awesome. We appreciate them. And thanks for doing all this for us and eXp.
Yeah.
We'll have money more. I have one more thing to add, Mike. We are also working with, because there's sellers that are like, I'm not moving. I need to move because we've outgrown our house, or this is too big for us, or whatever. And so they don't want to move because they don't want to give up their rate. But we can, and it's hard. It's not like it's, easy, but we have people that are in our pipeline that we're constantly, Gary's not me. Gary does all the work. I just keep everybody together, but he's constantly looking and constantly getting properties in front of them that they can trade. So we'll sell theirs and we'll help them find. So it's another, and again, they'll probably buy something that's not a low rate. Who knows? Because once somebody falls in love with the house, and once they decide, that's what they're going to do.
Well, one thing I like to say about getting people excited about assumables is that the thing you're actually doing is you're getting them deep into the calculations and into the numbers. And we've had people who actually owned VA properties that they had assumed with their own VA entitlement. We had that one gentle lady, Mike, you may remember her. I won't say her name, from about a year ago, and she wanted to do an assumption for the next property. She wanted to sell her assumable home with an assumption. And she was all set to go. She was so pro assumption. And then when we ran all the numbers with her on the equity gaps, and, because Northern Virginia is just, prices are skyrocketing. When she realized that if she took the 200,000 or so in equity that she had in this property that she owned with her husband, and put it into a brand new loan, the brand new loan's monthly mortgage payment was lower than the budget she had set for her maximum mortgage payment. And
Wow.
so
Do you have a training on that, Nora? Because I am not a numbers person and you just lost me. So do you have a training that shows that scenario? Because I think that would be really
actually Ryan Nelson can help run all those numbers. Ryan Nelson is our preferred lender, who's like the most knowledgeable assumable lender in the world. He joins us every single day, 5 days a week on that live training that I was posting about.
I wasn't, because normally, like when you're talking to someone, you don't have Ryan in your pocket, you know?
Well, what I like to do with buyers is I like to say, hey, let's identify your budget. Let's identify your monthly mortgage, your monthly housing costs that you'd like. Let's identify the max and obviously let's identify the smallest, let's get a range going. Let's get searches. And Mohammed, I hope you're still with us. Will you unmute and say hello if you're listening, hopefully? Because Mohammed had a great question about this. Hopefully Mohammed's still listening. Not hearing Mohammed unmute. So hopefully Mohammed will come to another training. But Mohammed had asked, what happens when we fail our buyers? And, we promise them that they can get this assumable VA property and they can't. And my answer to that is we never promise anyone that we can get them a particular property. We promise them that we can give them access to a world of possibilities, and that we're going to help them run the numbers and figure out how to, maximize their affordability while getting them the house they love, right? Because no one wants to move into an assumable home that they hate, right? If they're like, I hate this place, it's dark, it's miserable, it smells bad, right? You're not gonna, that is not a purchase right there, right? So you have to like the house, you have to want to live there, right? So what happens is, just to be clear, in case, not everybody knows this, if you're getting a $600,000 loan and you're putting down a 10% down payment, you're going to have, at 6.5%, you're going to have a certain monthly payment. Let's call it, I don't know, $4,500 a month. I don't actually know the numbers. I'm just guessing, but I'm probably not far off. If you put that $60K down payment down, that's $4,500 a month. If you put $200K down on the $600,000 house at 6.5%, your monthly payment will be lower than $4,500. It'll be closer to $3,800. So this is what our buyer discovered. She discovered that the amount she was squeezing out of her life to put down for a cash down, that she could put the same amount down. She was going to squeeze $200K out of the equity in the home she was selling and all of this stuff. She was going to squeeze this $200K in order to go assume a home, right, with 4 bedrooms and 3 bathrooms, right? She had just given birth to her 3rd kid, all of that. And she was trying to get a monthly mortgage payment below $3,800. That was what she was going for. And when she realized that with a $200,000 down payment on a $600,000 or $650,000 home in this area of Virginia called Woodbridge, she could actually achieve a monthly mortgage payment below $3,800. What she suddenly became aware of is that she didn't just have to limit her search to the 10 or 15% of the homes in Woodbridge that were for sale with assumable mortgages. Suddenly, she could open up her search to every home on the market, because with that $200,000 down payment, she had actually achieved the low, the within budget monthly mortgage payment. So this happens to us quite a bit. As people are running numbers, they realize, hey, there are houses I really like, and some of them are cheaper than the assumable homes. They have higher interest rates because I have to take out a new loan for them, right? But, there's a much wider range when I can look at anything. So what we're doing with the assumable opportunity is we're getting buyers off the bench. We're getting, homeowners off of the, out of the prison of rate lock, right? And they're actually running the numbers, which is so important. And sometimes the numbers lead them, with enough, destiny, enough stars aligning. Sometimes the numbers lead them to a home they love that has an assumable mortgage.
So I'm going to summarize everything Nora said into basically a single sentence. The end state for you as an agent is not that you have to do an assumption with all of your clients. The end state is you use this as a technique to open your funnel, draw more leads in, and close more deals. Some of those buyers will do an assumption and some will not. And you know what? That's okay. Your goal is not to push them through an assumption. Your goal is to sell more real estate, to help more buyers, to help more sellers, right, achieve their goals. And that same calculation that we often, sellers like, oh, I don't want to leave my current mortgage. It has a really great rate. Well, going through the math with them, getting them to open their eyes about what their options are, they may also find out that it is okay because they have so much equity in the property that they're selling. They have so much proceeds. They don't need to pursue an assumption to get a mortgage payment that they're actually comfortable with. And they may just go out and buy a new home with a new loan and be willing to get off the bench and sell their current property and do the move. And because you help them through that process, they're working with you and you just got a double-sided transaction out of that. So again, the end state is not that you have to help every buyer through an assumption. It's a tool in your kit bag to bring buyers and sellers off the bench, have that conversation, demonstrate value, and through that value proposition that you are offering that very few agents can offer, you are finding that you are selling more homes, you are supporting more clients, you are generating a bigger business, right? That's what this is about.